This evening I will be talking about bubbles in asset markets. So we know about bubbles. We need some water and soap, and we need a ring, and we move it, and we get one. It's pretty. And my son did this, but I think the video for some reason is not working. Let me try. And then we can start. Yeah. Well, okay. So the video, for this version, and the music is not there. So okay. So I will move on to the bubbles, because the question is, what are they? One thing, we know they form and they burst. And in life, the bubbles are invisible, not like these. And so we observe them only when they burst. Many examples are all over the world in time. Holland, is this a pointer? Australia, North Sea or South Sea, islands, everywhere. The big one, late 90s. And so, of course, they are there. Every day, actually. And they are there. And of course, one of the issues is that they form, but the economies are open, and they move on, and they cascade. And so, of course, this means they have no boundaries. And of course, next thing is that, if they have no boundaries, we get the crisis. It means less jobs and problems all over the economy, and that's why I'm interested in them, not just me. What I do is I drop. Okay. Outline. I will be starting by discussing the experiment, the first one. But then I will be talking about bubbles and rationality, and being an economist, for me, it's extremely important. Rationality. It's useful and important. And then I will be briefly discussing a bit of my research. Not much. A few examples only. Okay? Okay. Definition of a bubble. We buy anything and we pay more than the valuation of the good. It's a bubble. And then, of course, the issue is that what we buy then has no market. It means it crashes. That's a bubble. and it pops. Example, valuations. And we buy it, and the price goes up above the valuation, and then we obtain the crash. And the price, oops, goes to may not be a big one, it's a minor one. And the price goes up and comes down. It's a correction. Next, it's a bump. And of course, most are not noticed. That is, we learn about them ex post. It's too late then. And so it's like going to the doctor, and the illness is there. Ex ante, the doctor had no idea. Bubbles are like that. And so we know when the economy is sick, or the symptoms are there. Otherwise, we have no idea absolutely. Okay. The question is that if we know the value of the goods in the market, go to a store, I love wines, I check the wines, and I see the prices. And the price is there already, right? And I say, expensive. That's a good deal. And so, of course, the idea is that my valuation is different than the price marked. Right? Because of course in the real world, assets, it's much more complex. And so in terms of knowing the valuation of an asset, we have absolutely no idea. It's all guesswork. It's all guesswork. Oops. And the issue is that the valuations are there, and the valuations are different according to the individuals and what they know. And it's the reason, and that's good, and it's the reason behind the market. Otherwise, we have no market. Nobody buys or sells. No reason behind it. And so we need this. Rationality. Rationality is an idea in economics. It's a benchmark. It states when the world is perfect, we obtain this. We are efficient. The markets are efficient, and so on. Then, of course, if the markets are perfectly efficient or rational, means no bubbles. And also means no trades. No one buys, no one sells. That's it. The world is boring, actually. It's just a bit, boring. And that's why economic experiments are useful. And the reason is that the world is complex, and to observe one stock, let alone the market, is next to impossible. And so in the lab, we know the valuations, we assign the dividends, we know the environment, and we know the players, and we know the trades. But we also know the information. And we change those, and we observe the impact upon the market. We control it. Incentives are defined. That's important. And the reason is that the individuals need a reason to be in the market. No incentives means no markets. That's it. Okay, so now I will be discussing the paper which started this. Actually, it will be good if I can keep watch of time, because I don't want to be going for too long. Okay, it's an experiment. The idea was not of bubbles, actually. The idea was a simple one, and of course a complex one. The idea is a beautiful idea, and I was doing my PhD there, and I was in the experiments. And I love the paper, of course. Okay, so the idea is this. And so if we know everything, and so everybody knows it, and so the information is common. Anna knows it, and you know it. Ephraim, Bakar does, Yono does, and we all know it. And again, like now the question is, do we observe the bubble or not? That's it. And deep down it is rational expectations. And so the concept is a complex one. Oops. And so we know all this. And so the asset is they will die in 9 days or 10 days. It's all known. If you are rational, number one, we'll be observing no trades. Okay. And so, it is the question here. That's the idea. And the math and all that is besides the point. And what do they get? We know the valuations. We assign the dividends. We know the environment, and we know the players, and we know the trades. But we also know the information. And we change those, and we observe the impact upon the market. We control it. Incentives are defined. That's important. And the reason is that the individuals need a reason to be in the market. No incentives means no markets. That's it. Okay, so now I will be discussing the paper which started this. Actually, it will be good if I can keep watch of time, and I don't want to be going for too long. Okay, it's an experiment. The idea was not of bubbles, actually. The idea was a simple one, and of course a complex one. And the idea is beautiful. And my idea, and I was doing my PhD then, and I was in the experiments. And I love the paper, of course. Okay, so the idea is this. And so if we know everything, and so everybody knows it, and so the information is common. Anna knows it, and you know it. Ephraim, Bakar does, Yona does, and we all know it. And like now the question is, do we observe the bubble or not? That's it. And deep down it is rational expectations. And so the concept is complex. Oops. And so we know all this. And so the asset is it will die in 9 days or 10 days. It's all. If you are rational, number one, we'll be observing no trades. And so that is the question. That's the idea. And the math and all that is besides the point. And Morgan, there. And I was there in one of these. I'm not ashamed, actually. I was a part of the bubble. And adopting a bubble. And the bubble is this. These are the valuations, the trades, and the crash. This is the bubble. Then they repeated it. Maybe there. Not quite in that case. Okay? And what you observe is that the prices go up and they crash. It's a bubble. Oops. And then, of course, we got the economists in, and they said, wait a minute. I mean, these experiments, are in Arizona. Warm there, sun is strong, the brains are fried. And I will, not give more details, but it's a place where you expect people to be partying, undergraduates, not the graduates there. So, and they said, in Caltech, these guys are smart. In Arizona, it's a job. And they said, okay, go ahead. And then, these experiments, now have been repeated, across the world. With traders, managers, MIT people at Caltech, India, China, wherever. Bubble is still there. When they play it the first time. And then with time it goes down. And it decreases. That's with experience. But then if you change the environment, more cash flow, liquidity. And these individuals, and they learn the market, and you observe it once more. It's amazing. So, and then it's been tried in thousands of papers. These are all details, but the point is that bubbles are robust. Means that they occur all the time. Managers with experience, and then We change it once more, the bubble. And then the people, making, mistake, naive individual. And then of course, these days, with the internet and all, it's a lot. So for individual, to enter the market is much easier now. And they walk into the trade. Most of them, they lose. Okay. And so, my research. This one, it deals with information. And the idea is that I get a piece of news from Bakar, or from Ephraim, or from my son. Do I believe it? Tells about the university, Bakar is the guy. Finance, Ephraim. My son, I'll just go anyway. Source of the information also matters. And so the idea in the experiments was to test this. And of course, these are the examples. With the internet, on TV, and the gurus, and it's all there, right? And the information is there, and the advice is there. It's a quote by Greenspan. And this was after he left the Fed. I think it's been 2 months or so, not much. And he gave the quote here, about the crash. And he was in Japan or China. Next morning, there was a crash across the world. And why? Because everybody assumed it's Greenspan, and he knows, right? So for me, what's interesting is that Greenspan in those days knew little, no data-based opinion, and the individual still reacted. And then, of course, we saw that when we observe the messages, what matters is content and the source of it, and the belief source. It's a bit warm, it's good. Okay, one more example. Yellen and Draghi. Draghi, last year, or the year before, last year, and everybody was expecting the economy in Europe meltdown. Means no market for the bonds. And he came out, made the remark. Me and my son and Parliament, of course, nobody listens to him, so he's last there. And then the BCE, no, ECB, right, has spent nothing on this. And the markets are now stable. Information matters. And the message also, and so it's the paper, and so the effect of reliability and content, and and so on, and I like this paper actually. And the question is, they're the same. And so if I inform you, not in these words, the messages are in my pocket, and as the market goes on, I will be taking out a message randomly, and I will pass it around. By no means the message has absolutely no meaning to it. Right? And so we expect the individuals in the market, they should be ignoring the message. And the question is, do they? And if not, why not? And what kind of a message? Okay. And so they receive a message. The one is, the price is low. And the other is, the price is high. Why this? It's a long story. And so I will jump over that. Now we inform them, the messages are preset. And then they will be appearing on these days, 1, 3, and 9. And we make sure everybody knows about this. Reliability. The first ones are random messages out of the pocket, just like that. Preset. And we inform them. And the idea is, actually in theory, and these are the same. But in this case, the individuals in the room, they know that maybe the experimenter knows more about it. And they may give it more weight. And the last one is factual. And so the average of the last period, and we inform them it's low or high. Okay, it's a fact. And they observe it. What do we get? The message, so the price is low in all the cases, makes the bubbles small. And so it's the baseline with no messages, and it's the one with a message. No bubble. It's here a bit, but it's minor in this case. Okay. Next is if the messages are factual. based upon the market. And so it's an average. And so it's a fact. Well, again, much less. And so the impact of the message is very strong. And then we learned, one more thing, is that even with experience, and so if the beliefs agree with the message, we believe it. It's fun. And then the case of the random message, again, we look at this. It's amazing. Right? For me at least. Okay, again, with experience. The bubble is still there. So, what do we learn? We learn the source of the message is very important. And then the beliefs. And so if they agree with the belief, it may be a disaster also. The messages also impact upon the volumes. And then the messenger and the belief of the audience. And so, in this case, the messenger is Vakar. And the beliefs are out here. And so if we agree with it or not, okay, it's all. Okay. Next one, this one was a difficult one. Ambiguity in markets. Ambiguity. What is it? It's all over. The prices, when you buy a car, about the quality. Doctors make a guess. About the illness many times. Education, good or bad. Me being made the job offer. They may be scared initially. They're like, who is this guy? Did I make a mistake? Ambiguity again. It's out there, everywhere. Finance in this, the literature is big. And they claim because of this, the reaction in the market is much worse on both sides, above and below. And the math is. Okay, and so we said, okay, we go to the lab and we test it. And the idea is that in the lab, this is observable. Not in the market out there. In the lab, yes. Okay, and so it's a paper from last year, right? Okay. We know this, finance, oops. And I don't know why this is not showing, but, don't worry, not important. The key is that we all know, in the real world, the valuation of the stocks is ambiguous. It's the same slide twice. Okay, good job. And so the question is that if we observe it in the lab. Okay, now the question. This one was difficult. So we worked on this a long time. The question, and the reason is that on this, apart from the work of Ellsberg paradox, it was not much out there. We know this. In the lab, we control this. The problem is to ensure they believe us or not in the lab, the individuals. And so what we did was we took bags like these, black bags and sealed bags. And so inside, nothing's visible. Like these. Dividend stream, are two. Low or high. Coin is tossed, and we pick this or that. One of the two. Next one, we roll a die. And if the value is 1 or 2, not low. 3 or 4, not middle, and so on. And then toss the coin, and we get the valuation, depending upon the toss. Right now it looks simple, but it was different. What do we get? With no experience, that is, they walk in and play the game. The prices are much more. It's when the individuals do not know the environment or the market, they behave according to the model of theory. But then, they repeat it, and it just goes away. It disappears with experience. Volatility, the same. And we mailed, and we said, oh, wow. And we mailed the paper to the journals in finance, and they hated it. No way, no way. And then we went to economics, it was easy entry. Okay, and so we observe, in this case, in the environment that we employ, there's an ambiguity premium. Oops, what happened? So we observe this, but then it's for individuals with no experience, new players in the market, not the old players. And so it may not be as important. Oh, okay. And the last one. And so I will be brief. This one's a nice one. So we put the savings in funds, and the managers, they manage. And they use our money, not theirs, and they buy the assets. And so the question is that, are they careful? Do they take more risk or less? And of course, we know that for most of the cases, these guys are a bunch of idiots. I mean, it's clear. Bank loans, it's obvious. I mean, most of these guys, and I should be quiet because I can be quite outspoken. Okay, and so what we did was, we got the individuals in the experiments in asset markets. One treatment, the standard one, they got the money to trade. But the last ones were like this one. They get the money and the assets, and they trade in the market. And the other is, they come one day and they work for 90 minutes. In our case, we made them download like papers. So we gave them a list. They searched and went download. And we paid their money. And then they come back the next week and they play the game with this money. The question is simple. Okay? The money of the experimenter earned. What you observe is that the bubbles are there. And then the referee asked us to do more experiments, and we doubled it. And we got many more of these bubbles. Okay? The next thing is the volumes. That's interesting here. And so if they use your money, they trade much more, but much, much more. And if they use their own money, they trade much less. Like calmer. Like maybe they pause and think. Okay. Earnings, what we observe is that in this case, few individuals, like make much more, and like this one is flatter. And so the question was, why do we observe this? And so of course, we see that the bubbles are still there. The volumes are much lower. And so we decided to analyze the individuals in this case. How? Well, there's a test on cognition in psychology. But then I recall, when I was in India, taking the exams to get into banks, the test was, the same. And so it makes me a bit, mad because, like now we say it's other guy's test. But it's been around for a long time. But the idea is that many individuals are impulsive, maybe smart, but very impulsive. One example is my wife. She's very impulsive.
That's super smart too.
Because the issue is not about being intelligent. It's being impulsive or pausing and thinking and then moving. But then, of course, many individuals are zeros. The world, is like that. And so the test here. What's the answer? Right now. Nobody? See, that's a zero. What's the answer?
Fine.
Okay. Fine? Good. Everybody else? No, zero. Okay. Read this. Blah, blah, blah. It takes, like these many of your days. And so what is, the number of the days, for the lake?
Is it 5 cents?
I'm sorry?
5 cents?
But you already got a zero. Gosh, I'm sorry. Well, yeah, exactly. That's the answer. And so in this case,
47.
exactly. And the rest are zero. And so the idea of the questions are that the answer, which is intuitive, is the wrong one. One example, in this case it's 10. In this case it's 100. And in this case it's 24. And being impulsive, then you read 1/2, 24. Right? Okay, and so we employ this on the traders in the experiment. I use this, but earnings. The individuals with one or more score are these ones. And, sadly, these are the zeros. And what you observe is, with time, these guys make like less and less and less, and these guys make like much more. And what we observe is that these are the individuals behind the bubbles. And so when they need to be buying, they sell. And when they need to be disposing of the asset, these guys are actually up there at the peak. They are like buying like nuts. And that's why like these are the zeros, for a good reason. And of course, and so observe this. It's a big difference in earnings. On the average, many individuals walked out with $90 in hours. big, big difference. And so, what do we learn? And so even if the money is earned, we observe the bubbles. The volume is, much more. So is the variance. The ponderers earn much more, but much more. The people that are impulsive are behind the bubbles. And they buy at the wrong time, and they dispose of also at the wrong time. That's what I said. So what does it mean? The incentives for traders. Do we actually, make them buy into those assets before or not? And then, of course, we need data on the traders. Are they impulsive on risk, and so on. Education. I think it is the key. I know traders, honestly, these guys, they have no clue. But they're lucky on the average. But most are not. So, that's my story. And thank you.